Hello, in this video we will be discussing swing trading. Swing trading involves holding trades for around 2 to 7 days at a time. It is suitable for traders who cannot devote their entire day to monitoring the market. Channel trading strategy. Very simply, channel trading consists of trading price action within the confines of a trading channel. The price channel is defined by drawing trend lines between 2 or more swing lows plus 2 or more swing highs, and the price action is contained within these 2 parallel lines. For a bearish market, the price oscillates between lower lows and highs to form a downward sloping channel. The opposite holds true for a bullish market. After identifying a price channel, traders go long when the price touches the lower support level and enter short positions when the price touches the higher resistance level. Counter trend strategy. Many swing traders trade against the trend, and this is also called fading. Counter trend traders take bearish positions during an uptrend and bullish positions during a downtrend. Counter trend trading requires discipline, and using indicators is considered useful for this style. Technical indicators used for swing trading. Moving averages. This indicator is useful in identifying and confirming a trend. They help in identifying a clear price action by removing noise from random price changes. Moving average convergence divergence. MACD uses 2 EMA lines to show trend correlation. EMA crossover above the zero signal line shows a possible trend reversal and a signal to buy. If it crosses below the signal line, a selling signal is indicated. Relative Strength Index. RSI is considered the best indicator for swing trading as it gives an idea of whether the market is overbought or oversold. RSI has a range from 10 to 100 and uses momentum to compare gains and losses of each currency pair.